Hey, what's up everybody? Trader Tim from eManyMind bringing you another market analysis video. Today is Monday, January 26th, 2015, and we are at a very critical level here on the ES. In this video, I wanted to go through where we're at in terms of why these types of environments and this particular setup that we're in here is so important in terms of how it kind of leads us into the next couple of weeks of trading. We'll go through some individual stocks, and we'll talk about how we can make some broader analysis that will give us some direction in our short-term trades. So starting with the ES here, very close to breaking the prior swing high. The prior swing high, this is 24 hours worth of data on the ES. I have at 2062 is the high, and we're currently 2062.50. So, I'd like to see it break by at least a point, and to give that a solid break. So I'm considering this right now a double top. If we look at the little bit larger formations here, you can kind of call this a double bottom down here, and what I'm starting to see is the formation of an inverse head and shoulders, where this being the left shoulder, the head coming down here, also kind of making that double bottom, and then if we can kind of round out this right shoulder, usually what happens is we form a higher low on this side, so the head and shoulders, it kind of gets to look like an angle, kind of like this. So I would look for, a move, two things right here. Move down to 2016 and then a rally, or a push above highs in the next day that would break this prior swing highs. We are sitting right in the middle of earnings seasons. We've had a handful of bigger stocks, bigger companies announcing already, and that's starting to push the market in a little bit wider ranges. This week we also have the Fed meeting announcement on Wednesday, so that particular day, Wednesday morning, I would be cautious in my trading, and then in the afternoon I just kind of shut things down at about 10 o'clock Central Time, and then let the meeting announcement kind of pitter out and let all that chaos ensue, and then let the market settle down. And typically the Thursday after a Fed meeting announcement kicks things off with a very technical market environment. So because we're kind of at this pivotal point where we're so close to really having a solid break of this prior swing high, which would confirm that we're now pushing to new highs, versus in the sense that we have confirmed that we break the downtrend, I would look for that break of the prior swing high, a pullback, and then another high, which would give us a higher low, and then that would confirm the uptrend. So if we go over to the SPY, we can kind of see things a little bit clearer, along with some of the volume. You can see how the SPY didn't quite break above the prior swing high yet, so we're at a very critical level. If I go to a couple of stocks like Google has already broken that prior swing high, and I have this downtrend line drawn, and you can see back here, if I were to kind of pull back a little bit, coming up to the downtrend line, for those who were getting short at the downtrend line, they got stopped out, because the market, or the Google rather, pushed higher and broke the downtrend line. So at that point, as bulls stepped in, those bulls also got stopped out, because if you were buying on a pullback at the downtrend line, Google kind of had a little fake out and came down and made a new low. So the shorts got stopped out, the bulls got stopped out, and now what's happening is kind of a reactionary trade, if you will, where there's not a whole lot of new buyers and sellers coming in right here, because the shorts were stopped out and the longs were stopped out. So you get this kind of rapid move on the fake out. And now, because we have broken the prior swing high, we've put in the low, broken the prior swing high, I would look for Google to come down and form a higher low somewhere around 515 and push higher and break this swing high. And so Google, being an individual stock, I would look for the broader market to kind of follow some of these bigger name stocks. If we look at Apple and some of these other larger stocks, Apple has broken its prior swing high. Amazon also just pierced that prior swing high. So we're starting to see some breakouts in individual stocks, and so for that reason I look for the S&P to break as well. If I go to a weekly chart, some interesting things. If we use a 20 and 50 MA, I'm not huge on moving averages, but they can kind of give us a little bit of an indication when the trend is breaking. And you can see how we've just kind of pulled back to the 20 and rallied, pulled back to the 20 and rallied. We had one break down to the 50, and that has kind of kick-started this choppy period where the nice trend of higher highs and higher lows has been temporarily broken, and we've gone into kind of this sideways chop consolidation over the last couple of weeks. And if I take it down to a daily chart, I'm going to go out just a little bit to 2 years. Zoom in, whoops, zoom in a little bit. And if we look at every time we came down to, so now this is a daily chart with the 20 and the 50. Every time we came down to the 50, once we broke the 50% retracement short, the market has resumed to new highs. So from highs to lows, we're in a temporary downtrend. The market broke the 50% retracement short, so failed the 61.8, and we resumed the uptrend. Once again, broke the 50, resumed the uptrend, broke the 50, and as soon as we're breaking the 50, we're also starting to roll over with the 20. So what I'm kind of getting at here is if we go from highs to lows and we zoom in, we're kind of at the same scenario. The 20 is just starting to cross underneath the 50, but as we've seen here, while the 20 is underneath the 50 and curving and rounding out and turning over, that's when the market is getting its rally. So it'll be very interesting to see and very critical to see if we can break the 50, which also breaks the prior swing high. If we can break that swing high, then I would certainly look for the markets to push to new highs. If we can't, then that would be the first time that in almost 2 years here of data that the market has come back up, pulled back a little bit, started to rally, and wasn't able to make new highs. So when we're at these critical junctures where we've seen the same thing happen over and over and over again for a couple years at a time, it's important to identify if we're getting a shift in the market sentiment, a shift in the direction in resuming the trend. So very important these next couple of days, both with the earnings announcements coming out and the FOMC meeting. There's a lot of catalysts to really push the markets and have some really wide range days. So it's important to stay patient through weeks like this, because you don't want to just start jumping in and getting on board and getting stopped out and taking revenge trades and things like that. One thing that is really important to remember is that while we may be short-term traders, we're in this for the long haul, over a period of years, and essentially a lifetime. We want to be able to trade for a lifetime, and the only way to do that and to be in the game is to remain patient on the shorter term time frames. So if you can just keep that in mind, that really this day and this week is such a small fraction of the larger picture that is 5 and 10 years of trading opportunities. But it's these pivotal points, if I go back to the ES, these pivotal points where we're about to break a swing high or break a swing low or start a new trend when we're making a lower low, lower high, lower low. And now this would be the first, if we can break this swing high, pull back, that would be the first leg of the resumption of the uptrend, and you want to get in as close to the trend reversal as possible to get the most out of the trade. So lots going on this week, but it's really just as simple as waiting for or watching for a break of that swing high. One last interesting thing, two last interesting things. If I go to, I think I went to a weekly chart. Clear Studies. This bar back here on the middle of December will be the pivotal level, if you will, of breaking the high or breaking the low. Once we break one of these, we're going to see a lot of technical trading and a lot of good setups. So as long as we're within this range, I would look for the market to continue to be choppy. Once we break out of this either high or low of this kind of box pattern we have here, then I would look for the market to resume a very strong trend in either up or down. So that's kind of our line in the sand. The other interesting thing to note is gold has broken out of its downtrend that it's been in for quite some time, with some strong volume as well. So we're getting a shift in some of these individual stocks like Google, as well as some of the commodities like gold. Not a whole lot going on with the VIX in terms of anything to give us an indication, as we're sitting right in the middle at this point. But I would look for a rally in the ES to be in conjunction with a decline in the VIX, and I would like to see it get back down to 12 if we're to break new highs. At the same time, if we start to sell off in the ES, I would want to see a rally in the VIX, and I would want to see us get back up here to 25 or higher to really send us to new lows. So in the meantime, while we're within this kind of 12 to 22 range, I would just continue to expect a lot of chop on the intraday time frames. So that's what I'm looking at for this week. Again, be patient out there. It's okay to have a day where you make no trades. It's okay to have an entire week where you just kind of sit back and let the market do its thing. And if you can just be patient in the really choppy times and then hit it hard when the market's trending and when your setups are rocking, that's the way to really maximize the winners and cut down on your losses. Because if you go back through your trades, if you were to kind of list them, typically you'll be able to find clumps of losing trades and clumps of winning trades. As opposed to winner, loser, winner, loser, winner, loser. And if you can just kind of minimize your trading during those tough times or during those choppy times, if you're trading more of a trending setup, then once the market's trending, you have more cash, more ability to go bigger when the market's more conducive to your setups. So that's what I'm looking at for right now. As always, if you have individual questions, shoot me an email, tim@emoneymind.com, and you can get all of the webinars from the archive, all of the how-to videos, and the step-by-step walkthrough tutorials and things like that on my trading screen, and all the other things that are kind of incorporated into my trading and my longer term investing over at the eMoney Mind members area, the VIP area. So with that, I hope you have a great week, and we'll talk to you soon.